With the election just around the corner, many investors are left with the inevitable question: what happens next? Will there be a contested election, and where will that leave stimulus? Here to discuss what's next for the markets is Jeff Marks, Senior Portfolio Analyst with Jim Cramer's Action Alerts Plus, and Real Money contributors Chris Versace and Bob Lang. I want to start by discussing election volatility and how best to protect your portfolio. Now, this is something that I've discussed with Jim Cramer time and time again, so I actually want to start with you, Jeff. How are you advising members of Action Alerts Plus to protect their portfolios from volatility?
That's a great question, Katherine. And I don't think anyone really needs to make any drastic changes to their portfolio solely around the election. I think you can try and position on how the election is going to fare, but trying to predict an outcome has been a sucker's game, as we saw after 2016. So what I would say is, if you're nervous about the election and the general uncertainty, what you can do is you can keep enough liquidity in your portfolio just to meet your financial needs for the next couple years, and keep some dry powder on the sidelines for a pullback. But if you want to stay invested in the market, which we're trying to do over at Action Alerts Plus, I would keep a portfolio mixed with secular growth winners, market share gainers, and strong free cash flow generators, because those businesses they're really going to be indifferent to what the election outcome is. And let me give you an example by what I mean by that. We've liked a company called Marvell Technologies for the longest time. And while we always recommend this stock, whenever there's a nasty sell-off in the market off of some headline that has nothing to do with the company, is because of its business prospects. And its lead business right now is in 5G networking. And the 5G investment cycle is coming regardless of Trump wins, regardless of Biden wins. And the company also has great exposure to secular trends in the cloud, data center, and automotive Ethernet. So what I would say, if you're trying to protect around the election and try and thwart off some volatility, keep to your game plan, hold some cash if you're nervous, and go for those high quality names that are really indifferent to what happens election night.
All right, Chris, what's your advice?
Well, I would echo a lot of what Jeff had to say. I think it's very sound, sticking particularly with those companies that are going to benefit from structural change. He mentioned 5G. I think that's a home run idea for the next several quarters, at least, if not longer. But there's other things that are happening. Some of these structural changes were around before the pandemic. They will be around after the pandemic. And in some cases, the pandemic is accelerating their change. It could be digital shopping, for example, or online groceries or something like that. But one of the things that we have chosen to do over at the Trifecta portfolio that Bob and I co-manage together is to introduce some downside protection in the form of inverse ETFs. And, throughout this year, whenever the market has gotten a little rocky, they have been there time and time again, really limiting the impact of the market's volatility, while we've been able to benefit the rebound in the market or the continued rise in the market with our long positions, which, again, really speak to a lot of these structural changes that Jeff was alluding to. And there, I'm sure we'll talk about others on the rest of this presentation.
And Bob, do you agree with what Jeff and Chris have said, and how have you been protecting your portfolio?
Yeah, both of them are absolutely 100% correct. I want to go back to one thing that Jeff talked about, was trying to predict what's going to happen as it relates to your portfolio. I think it's really kind of a waste of time. I agree with Jeff, trying to game it, the results, whether they come out being the Republican winner or the Democratic winner. I think what's interesting here is many players out there have tried to use the 2016 playbook for 2020, meaning elevated volatility, looking for big swings up and down the markets. Now, don't forget, when volatility rises, as it is right now, we see the VIX ticking in around 29, 30%, about 50% higher than it normally has been historically. We see large moves up and down in the market. So it's not just that the markets are showing fear or scared or worried players. It means that big moves up and down are going to occur in the markets. And like we saw earlier this week, we saw last Monday, we saw the markets up a lot on Monday, came down a couple of days later on the week. We said with the large ranges going on, it makes people nervous, right? And so I think that that playbook that is from 2016, when we saw a lot of volatility coming in, a lot of people have been preparing for that. I don't think that is going to occur like it did in 2016. I think people are overly concerned and overly worried that there's going to be some big swings in the market and the market's going to take it down. Look, let's face it, the stock market is a discounting mechanism. It looks ahead 6 to 8 months. And I think by now, we're only 2 weeks out from the election. I think the market has already looked beyond what's happening with the election, is looking at the economy and what's going to happen maybe post-COVID or post-election.
So one really important point that I've heard is not to game the election results. But it's inevitable that we have all these new retail investors. We've got Robinhood investors and the like joining and creating portfolios at this time, and they're going to be looking for stocks to watch. So I want to ask Chris, what are 3 stocks that you're watching ahead of the election?
Well, if you're looking for one specifically tied to, the outcome, should it go one way or the other? Some of the areas that I'd be focusing on would be some of the alternative energy names, solar energy, for example, in that arena, some of the electric vehicles. I think if the Democrats win, I wouldn't be surprised if we see the Green Deal agenda get advanced even further. That probably means, on the other hand, that some of the more traditional energy sources, coal companies and the like, for example, we may not want to, own. I think one of the opportunities there, kind of mixed in between, could be some of the more traditional car companies that you would think that would get hit, but are busy trying to reposition their business into the EV space. Here, it could be a company like Ford, GM, which just announced the new EV Hummer, and it instantly sold out. So in addition to, some of the Green Deal names, I do think investors are going to continue to see the accelerating shift for some of these structural changes that we talked about. Jeff alluded to 5G earlier. I talked about, the impact of the pandemic accelerating digital shopping, even changing digital shopping. If we take a look at the names like Carvana and the like, they're simply exploding from this change in behavior. I think a lot of those will be cemented even after the election, just given the structural dynamics that have emerged. So those are some of the areas, Katherine, that I think some people should look for, as well as maybe some other new opportunities that are taking advantage of these structural changes. Companies like a Farfetch, for example, that is really the intersection of luxury goods and online shopping.
All right, Bob, Chris is your co-portfolio manager on Trifecta Stocks. Do you agree or disagree? And do you have anything else to add?
I agree with Chris on that. I think also one area that I'd be taking a look at right now is I think the trajectory of earnings out in China have kind of turned and had an inflection point, is starting to rise. One of the names that we have in Trifecta is Alibaba, and it's one of the biggest and best companies in the world. It's the biggest, I think the biggest one in China. And, Chris has talked about that endlessly, about the retail sales, the advantage that they have is selling stuff all around the world. And don't forget, we have a big selling day coming up November 11th, a Singles Day, one of the biggest selling days around. And I think it's Alibaba's biggest day of sales outside of Christmas and the holidays. So it's much similar to what Amazon does with their Prime Day, which they had last week. So I was look at that, and also look at Caterpillar. That's a big name, big cap name. It's industrial name in the Dow Industrials. That stock has had a really nice run since the bottom in March. It's almost at or near a new all-time high, and they do sell a lot of equipment into China. And some of the clues that we've seen is obviously just the earnings trajectory and some of these names that are China-related, the GDP, and then also one other clue that China is really getting their act together is we've seen highs in copper recently, and we know that when copper is low, that China's in there buying copper aggressively with both hands. So I think that some of the names in that that follow that theme are probably a good place to go.
And Jeff, give me a sneak peek. If I'm not a member of Action Alerts Plus, give me a sneak peek of the kind of advice that you're giving your members on stocks to watch ahead of the election.
Well, so that's a great question. I'm glad you asked, because the election, how the election was going to impact stocks was probably our most asked question heading into, we do a monthly conference call, and it was last weekend. The most asked question into the event was, how is the election going to impact our stocks? And surprisingly, what we found, we went through our entire list of around 32 stocks, and about 2/3 of them we actually thought would be in favor, surprisingly, of a Biden election. But you mentioned the retail investors before, and just kind of one sector I wanted to touch on for a minute, because I think there's a lot of big election implications. for this group of stocks. And it's not necessarily a group that I would go out and say buys, because there's a lot of risk and uncertainty in it. But the cannabis stocks, I think, are a good example of one that could really benefit from a Biden win and a blue sweep. Legalized recreation use is on the ballot on a bunch of states, and you have medical on the ballot at a state as well. And I think if we do see a Democratic sweep, you could have an easier regulatory environment, and that could set the stage up for in the years to come for a potential legalization at the federal level. And that's really what would need to happen to really see this sector light up, so to speak. So I think if you're on the lookout for a cannabis stock, and again, these are probably more so good for high risk tolerance retail investors. One would be Canopy Growth Corporation as a consumer goods play. They have the tie-in with Constellation Brands, or Grow Generation Corp, which is essentially the Home Depot of growing cannabis. So those aren't exactly stocks we're recommending for Action Alerts Plus right now. We like to stick to the large cap names, and we're looking for a lot of stocks with the structural changes that I mentioned earlier. But I think this is a group that you got to watch on election night to see how it performs, because they have certainly been rising in recent weeks as Biden has sort of extended this lead in the polls.
All right, so I want to stick with talking more to the retail investor, giving them advice, especially, right as we lead up to the election and possibly right after in the next couple of months. So Bob, I want to start with you, and I want to ask you, rapid fire, give me one sector to watch and why.
Retail. This is an area that I think most retail, not meaning the retail investor, I mean retail stocks, the retail group, meaning stocks like Amazon, Lululemon, and even going out to the restaurants like Chipotle, McDonald's, that sort of stuff. So I consider them all retail, all in the whole basket over there. I think with holidays coming up, I think a lot of holiday shopping that's going to be happening online, and especially Amazon is going to take advantage of that. And anybody that's got a good, strong online strategy like a Walmart and a Target, they're going to take advantage. They're going to have a windfall of sales coming into their holidays. We just added, actually this week in Trifecta, we added Walmart just yesterday, and it's starting to do real well for us. And we think that the stock has got some legs into the end of the year.
Now, Jeff, you just said watching cannabis, potentially, especially if we get a Biden victory. But let's say we get something, perhaps like a Trump victory. What sector should I be watching post-election?
Yeah, I think a good sector for a Trump victory would be managed care. I mean, this is a group that always gets beaten down whenever it seems like the Democrats are really leading in the polls. We saw this group really take off towards the end of 2019 after Elizabeth Warren, who was once leading for the Democratic nomination, after she sort of fell by the wayside in the polls. So in that group, our favorite is CVS Health. It's really cheap on an earnings basis. We really like the vertical integration between Aetna, the PBM business, as well as the Health Hub store expansion that they're doing right now, and they're rolling out. But if you want to go best of breed, United Health Group, it's a name we've been in and out of through the years. Really strong business. They're consistently growing earnings on a double-digit basis. Capital returns, always a focus there. So if you think this is going to be sort of a status quo administration with the Trump win, I would say managed care definitely has room to run.
And Chris, I'm a new investor. This is my first election. What sector would you advise me to watch?
Well, if it's a sector to watch in terms of, hey, I'm unsure of which way to go, I think we've covered, a good number of ones already. However, I think I would have to say it's really going to be the larger healthcare. I do think that if we get a Democratic win, I wouldn't be surprised if, a revamped Obamacare comes through. And I think that's one that you're going to have to pay attention to. It also ties very closely with this aging population that we have in the U.S., but also outside of the U.S., whether it's China, Japan, or some of the other geographies out there. So there's a long-term tailwind in there, and I think that could present some opportunities at the right price, depending on what happens in the election.
So let's talk about opportunities at the right price. Bob just said that for Trifecta, Chris, you guys have bought Walmart recently. Now, if leading up to the election, just a couple months after, what's a stock that I should be buying?
So we're talking, early 2021, Katherine. Is that what we're talking about? And instead of,
Correct.
say, for example, the traditional holiday trade, correct?
Correct.
If we were to look at one right now and we actually own it, I would probably say, given the build out, of 5G, continued data center growth, and overall chip demand over the next several years, it's going to be a company like Applied Materials that makes the machines, that makes the chips, whether they're fabbed by Taiwan Semiconductor or Intel or others. As we continue to see the chips becoming the increasing fabric of our digital lives, I think we're going to continue to see robust demand for semiconductor capital equipment. And remember, too, China has come out and said that they are trying to drive greater in-country capacity for chips. I think whether it's Applied Materials, Lam Research, I think either one of them is going to be a good beneficiary of that.
All right, Jeff, give me a sneak peek into what Action Alerts Plus is thinking. What kind of stock should I be looking to buy?
One stock we've been really interested in adding to on a pullback, it's a stock we currently own, is Take-Two Interactive. We just think that there are so many great tailwinds in the video game business right now, whether it be people playing video games more often because they're staying at home and they're looking for ways to stay entertained at home. You also have a console cycle, the first one in years. That's about to come in November with the launch of the new Xbox and the new PlayStation. And why we like Take-Two specifically, they have one of their biggest pipelines ever in the company's history that's set to really take shape over the next couple of years. So once we have these new consoles out, there's just going to be a large amount of new titles hitting it. And of course, we'll see a new Grand Theft Auto, which has just been an absolute cash machine for the company. Hopefully we see the next iteration over the next couple of years. I think that would be huge for Take-Two Interactive.
All right, and Bob, we're leaving Walmart out of this. What other stock should I buy?
I'm looking at the airlines right now, and I know that they're sort of out of favor right now, and not many people are paying attention to what those airlines are doing. But they pretty much bottomed out. I know there's going to be some sort of injection of money from the government there. They pretty much have cleaned out all the sellers down here. It's not generally my favorite type of trade here at the bottom, but I think that over the long term, over the next 2, 3, 5 years, these companies are going to do extremely well because the travelers are going to come back. I know it's just going to take a little while, but I think over the long term, I think if you buy like a Southwest or a JetBlue, or one of my favorites is Hawaiian Airlines. It's really basically the best and only one that flies out to Hawaii, and Aloha. I'm sure everybody would love to take a trip out there on vacation. And when things start normalizing again, I think a lot of people are going to be taking those vacations, those trips that they missed out on 2020.
Is that a 12 to 18 month play for you? And you're kind of, betting that the vaccine comes along and then normalized behavior comes? And they're effectively bottomed out where bad news is not really going to push them much lower?
That's right, Chris. And I think probably even longer than that, I'd say probably 3 to 5 years. I think if you have a longer time horizon, these particular names. I'm not so in love with American Airlines or United Airlines so much, but certainly the Delta, I think, is a strong one. Southwest, and again, Hawaiian Air, even Alaska Air has got some good routes as well too, and they're starting to make money again. So I think 3 to 5 years out, Chris, I think that's going to be your timeline for these things. And I think if you're buying them here today, 2020, I think if you're looking at 2023 to 2025, you're going to be in good shape.
Chris, do you agree with that?
I do. I mean, it's a long-term play, and it's if you're willing to hold it for that long, I think the strategy will play out. There might be some false starts along the way. We might get, the stocks could trade a little lower depending on what happens in terms of the resurgence of the pandemic. We're seeing new fresh lockdowns in the UK and in France. My understanding, the same thing is happening in Italy as well. So, these stocks have been beaten up. We know they're, slashing their capacity. But if you're willing to hold them for the time period that Bob is talking about, I would like to say hopefully this pandemic at that point is a thing of the past. We'll see.
Yeah, so we actually just started a position in Boeing over at Action Alerts Plus. And when we looked at the company, we saw a lot of progress being made on the regulatory side with the 737 MAX. We've had European regulators recently pretty much give their blessing. Nothing final yet, but they've given their blessing that it's safe to fly. And you had the head of the FAA in the US test flight the 737 MAX, and he seemed to give a positive review. So we started our position in Boeing. We understand it's going to be a very long time for air travel to come back, but sentiment is so poor in the stock. We think that finally this overhang related to the 737 MAX, this saga, is finally going to come to a conclusion by the end of this year. We're already hearing routes being picked up at the end of this year for the 737 MAX. I believe it was American Airlines. They said they were going to start one towards the end of December. And finally, they'll be able to start really delivering these planes. And we'll finally see cash flow inflect in 2021, inflect back positive. And then look, if we're looking out to 2023, I think the cash flow per share could be greater than 20 bucks. And I think that makes Boeing very attractive today if you're looking out that far in a free cash flow yield perspective.
Bob, that isn't a stock that you mentioned. You mentioned strictly airlines, but would you consider Boeing too?
Yeah, no, I would agree with Jeff. I think all the airlines and Boeing are kind of on a similar trajectory in terms of recovery. I'm a little bit more leery about Boeing right now. I know that Jeff does amazing work, and I think over the long term, Boeing is going to be a good play for Action Alerts Plus and the subscribers. But I would agree with him. I think that the airlines themselves, with the increase in profitability, and as Chris said, they're lowering capacity, that profitability is going to start rising in the out years, probably 2-3 years down the road. And again, crossing our fingers, hopefully this pandemic is over by then. They should, see some good profits and prices rising in the stock.
Well, perhaps not even then. I mean, Jim Cramer has told me time and time again that he feels that airlines and being on an airplane is one of the safest places you can be because of all of the shock that they've had to go through at the beginning of the pandemic. Chris, I want to start with you because I want to ask you, what's a stock that you're avoiding right now?
I think to some extent the argument could be made similar to what we were talking about with the airlines, that if you're looking to buy energy, oil today, for example, and you're willing to hold it 1 year, 2 year, 3 years, as the global economy finds its footing and rebounds, odds are that the demand for oil will rebound as well. But again, you've got to be patient with it.
We're avoiding energy, Chris. We really don't like oil. We don't really like energy or gas. I'll pick it up. And basically the reason for this is that the demand for oil around the world is pretty much been going down ever since the pandemic started, and we're not seeing any much of anything from any of the OPEC countries or the non-OPEC countries saying that demand is going to be picking up around the world over the next 2 or 3 years. So, could we see oil, if we flash forward 2 years from now, 2022, 23, could we see oil still around 40, 42 bucks a barrel? Absolutely. And I think these companies that are here in the United States are gonna suffer with oil down that low. I think some of these fracking companies are still going to be at risk, especially if a Biden presidency comes around. I think certainly he's talked about not touching fracking, but we know that influences coming from the liberal side, the Democratic side, are going to probably have an effect on policy. So I do think that energy stocks are an area that we really need to avoid. And listen, I mean, they may look cheap on a cash flow basis or on a balance sheet basis, but to be honest with you, if the demand isn't there and they're not selling oil out to their distributors, it's going to be a tough road to hoe.
I think that there are two interesting points to make about especially energy and oil right now. And one could be, we're seeing cars being sold at a higher rate because of the pandemic, because people for at least the next year and a half don't really want to be taking public transportation and therefore are spending up to get their cars, but also the consolidation in this space. I mean, we're seeing a lot of M&A activity. What do you guys Bob and Chris, what do you guys think about this point?
So Katherine, your point about the rebound in auto sales, I think is fair. But I think when you parse the retail sales data and you look at gasoline consumption, it's actually down. So I think you have to be careful in that, right?
All right, and Jeff, what stocks is the portfolio advising investors to avoid?
Yeah, I think I'm just going to pick up on this conversation. It would be oil stocks. We cleared the portfolio out of all things related to oil earlier in 2020, and we really haven't looked back since the pandemic. I don't think these yields are attractive because I just don't know if I can trust them, and we never like to reach for yield. We don't think that's really a good way to invest, especially over the longer term. And there's just so many structural limitations to that industry right now. And I think you can't really trust OPEC too, because those nations, they need money too, and they're just going to keep producing as much as they can without really respect to price. So for an industry that really needs to see prices go higher, yes, demand will come back, and that's one side of the equation. But on the supply side, I don't see it happening in favor of the oil stocks.
Jeff, that is a fair point on OPEC. Historically, when we look back, they have had moments of solidarity, and they've had other moments where they will simply turn on each other, particularly when things get tough. And I think that's a very, very fair point that people need to consider. And Katherine, while I stole the mic, I'd also say, going back to the question, other areas to avoid would be restaurants, but a particular kind, not necessarily those that are benefiting from mobile ordering, digital ordering, or even drive-through, for example, like a Chipotle at McDonald's, but those that are still reliant, incredibly so, on the dine-in experience. We are seeing COVID cases come back. We tend to lag Europe by about 4 to 6 weeks or so. So if you're contemplating something like a Red Robin, like a Cracker Barrel, for example, those types of restaurants, I would suggest that you kind of put them to the side and maybe revisit them in a couple quarters.
What about restaurant companies such as Darden, which has such an expansive portfolio? Should I still be avoiding that?
I think Darden's a tough one, and I say that because they have done some good things and they've embraced, mobile ordering. I would still favor, I think, a Chipotle, a McDonald's, a Starbucks even, that have, again, just really, really embraced mobile ordering in a much, much greater degree.
All right, so we've talked about restaurants and we've talked about energy. Any other sectors to avoid, Bob?
Some of the higher end retail names have, really kind of, they stalled off after the end of the summer. We're talking about names like Ulta and even Lululemon. I love Lululemon in terms of their earnings and their growth trajectory. But they seem to have stalled out a little bit. I'd almost throw Nike in there as one of those high-end retailers. So I think using a little bit of caution with some of these high-end. Tiffany's, that deal with Tiffany and LVMH, Louis Vuitton didn't happen. Signet is another jeweler's high-end name that you really have to be careful with. So some of these high-end retailers are the ones you got to be careful with, cautious with. I'm sure they're going to do fairly well during the holiday season, but again, it all comes down to if they have an online strategy, then they can fight with the mighty Amazon and some of these other big players. If they can't, they're going to have a tough time going into 2021.
Jeff, do you agree with that?
With some respects, we own Nike over at Action Alerts Plus, and we just think that they're going to have a huge holiday season. And what drew us into this name specifically is really the benefits of their digital direct-to-consumer strategy. And what we're really anticipating this holiday season is it's going to be dominated by e-commerce. And so when we have that, and when you have a Nike who is much more profitable when they go direct to consumer compared to wholesale, if we really see this explosion, a really continued explosion of elevated e-commerce sales at the company, coupled with perhaps easing trade tensions in China with the Biden victory, and we know the China consumer is doing quite well too. We think Nike sets up well for the holiday season into 2021. really just based off this digital strategy.
Hey, Jeff, isn't the current CEO's background in digital commerce?
Yeah, so you're absolutely correct. The CEO, John Donahoe, he came over from ServiceNow, and really ever since that he joined Nike, he's really pushed and really accelerated this digital transformation that they're going through. He's laid out a multi-pronged strategy on how Nike is going to be the absolute leader in digitization, increase engagement with its customers, and I see this playing out over the next few years. And it's remember, the digital strategy is accretive to earnings. So the more they sell directly to the consumer, the better it is for margins.
All right, Chris, I want to take 10 steps back. And I want to say we've got this brand new Robinhood investor, and they're looking to understand how to avoid a stock or a sector, but they're not quite sure, besides for reading up on market news every day, how they should pinpoint those red flags. So walk me through that.
Sure. So I think there's a couple things that you should do as a newbie investor. It's really, the four of us would say is doing your homework. One, you want to understand exactly what is it that the company does, what's its competitive position, what products does it make, who are its key customers, key suppliers, that sort of thing. Then you're going to want to take a look at any economic data that you can, or industry data that talks about the trends that it serves. Again, whether it's a particular niche market or the overall market. For example, if it's a retailer, what's going on with the monthly retail sales numbers for the last couple months? What does it look like? The other thing is you want to roll up your sleeves and take a look at its financial statements. What is the trend in its margins, whether it's its gross margins, but really for me, it's going to be its operating margins. What are the trends? Are they expanding? Are they declining? If they're declining, why are they declining? And what's the downside risk there? And then probably the greatest litmus test for me right now, and I should have mentioned this earlier, is what is the expectations for earnings? Not in 2020, because we know we've been hit by the pandemic, but what is it in 2021, 2022 compared to 2019? If we look for the S&P 500, for example, expected earnings 2021 over 2019, there's just about 2% EPS growth. So if you're still below that, if your earnings are contracting, you probably want to avoid that for the most part. On the other hand, if you've got, like we've talked about earlier, a number of positive tailwinds, if the company is executing new products, new services, is able to put price in, if they're going direct to the consumer, they're expanding margins, and they're growing their EPS, those are all the things that you should be excited about.
Now, Bob, we know that the market probably shouldn't be reacting to, for example, the stimulus talks the way that they have been, and yet we still see that these headlines drive the market. So it's inevitable, in my eyes, that the election results, whether they're contested, whether we get a clear-cut winner, they're going to impact the market. So what's your advice for investors?
Well, volatility futures right now are extremely high. They're elevated for that very reason, because a lot of people are uncertain, they're unsure, and they're unclear about what the result's going to be like. Is there going to be chaos? Is it going to be calm? Is it going to be a nice transition of power if there is one, or it's continuation of the prior administration? We don't really know how it's going to unfold. We do know that people are nervous. We do know that people are worried and scared about what's going to unfold afterwards. And I think, by and large, if you just take the approach of just being calm and let's dial right back to what Jeff said early on in our conversation here. Just it's not really making much sense trying to game what the election results are going to do and how the market is going to respond to it. And I think approaching the election night and the results, you got to stay calm and just I think have a lot of cash available, have some protection on just in case. We always, like as Chris said, we have some inverse ETFs that work for us in case the market has a swoon. Certainly worked for us in 2018 in December, and also earlier this year in February, March of 2020, helped us alleviate some of that volatility in our portfolios. But I think having a little bit of cash, having a little bit of protection on, keeping some positions on it and keeping an eye out, being aware and ready for action in case some stocks that you wanted to have for a long term actually dip for you.
Jeff, walk me through what election night is going to look like for Action Alerts Plus. What are you and Zev Fema, who's also a research analyst with Action Alerts, going to be talking to Jim about?
Look, I think when it comes to at the end of the day, what we have to remember is that history says equities tend to rise in the 6 months after the election, and that's excluding recessions, of course. But and I don't think we're in a recession now, and a new stimulus bill will definitely help us avoid a double dip recession. But so if you use that historical trend higher, and you try and explain why, I think the main reason is because a large uncertain event is being taken out of the markets, and the markets hate uncertainty. So when we finally have our election outcome, as long as it's not, potentially contested, that uncertainty is gone. So I think that just lifts a huge overhang that we've all been talking about for weeks and months now. All of that gets away from the markets, and we can focus back on really what drives stocks, and that's going to be earnings. So what I would say is look past knee-jerk reactions. If you came into the election with an investment plan, which I hope everyone does, I don't think you need to make really any drastic decisions based upon who wins.
All right, Chris, you know what I'm going to ask, I hope, because I love coming to you for educational questions. Let's put it in the scenario that it's a contested election. What's your advice for me? What should I be doing?
I already have that. I was actually going to break in and say something about it when Jeff said contested. If you're a new investor, an old investor, here's my pick for the contested election. That would be Costco. I think that if people are nervous up ahead of it, people are going to stock up. And if we get a contested election, people are going to stock up even further, whether it's, groceries from Costco, other goods. I think Costco is going to be a huge winner when we look at their November same-store sales sometime in December.
That's a great idea.
And I think that is the best place that we could end this. So guys, as the election nears, TheStreet is here to provide you all of the market coverage you need to protect and prepare your portfolio. I want to thank Action Alerts Plus Senior Portfolio Analyst Jeff Marks and Real Money contributors Chris Versace and Bob Lang for joining us today.